Okay, here's the boring bit. Anything you hear or see in this video is not investment advice. It could be absolute rubbish. Please do your own research. Hi there, I thought I'd do an end of year review. It's been a hard market, but listen, hopefully I'm going to do 3 things here that will help you in a tough market. And this video is basically called 3 ways to increase your chances of making money and to reduce your losses, because I've had a couple of emails, a couple of people saying they're finding it hard. And I did say earlier on, what's your new year investing resolution? And many people said just give up and get off AIM, which is a pity because, of course, when there's money in the market, it helps everyone. When there's lack of liquidity, we suffer, and that's what happened this year. But I'm going to go through my portfolio performance and go through those 3 ways. Hopefully, will help you in the new year increase your chances of making money and reducing the chances of course, as important, of cutting those losses. But in the meantime, if you like this video, by all means hit the subscribe button and the notification bell. Don't forget that. And you get the next video straight to your inbox. I haven't done a lot of videos recently. Of course, it's Christmas, been on holidays, stuff like that. But I intend to do about one a week in the new year, in 2020. So don't forget, hit that subscribe button and notification bell. Okay, let's get into it. Okay, here's 3 ways to increase your chances of making money and reduce your losses, because they're both, of course, equally important. If you are, getting those spike ups and you're managing to catch those winners, if you're losing as well, then that's taking your profit away. So you've got to do both. First and foremost, I want to do my, my returns this year for my ISA stock shares account. So this is what I've done so far this year. 3 months, I've done 4.29%. Last 6 months, it's been tricky, 0.72%. I've had a good year though. It's been a decent year. I've done 112% over the last 12 months, and I've done 185% over the last 24 months. I've got to say, last quarter has been the hardest, really tricky market, but I'm still profitable. This is my, I think, 12th year which I've made a profit on the market. Listen, before that, I wasn't making good money. I was losing money. Literally, I went from, at the start when I started investing, I had a bit of cash. I had less than, 10 grand? Pretty much, and I made losses. In fact, a bit more than that. It went down to 10 grand. I made some silly mistakes, made some gambles, made some punts, lost a lot of money. I basically more than halved what I had at the start, which worried me. And now I'm going to say, going from where I started at, it's more than 50 times. This is what I originally had, and then I lost half it. But going where I wanted to had, more than 50 times I've done now in the last 12 years. So I've done well in the stock market, but it's come by a lot of losses, a lot of mistakes. And listen, you only learn by mistakes, honestly. And I keep learning all the way. That's why I love investing. It hits you in the pocket if you don't learn fast. All right, so I'm going to give you 3 things that I've learned. I'm still evolving. My portfolio is evolving right now, and I'm tweaking it all the time. If you go back 2 years, I was a different investor to what I am now. The market's changed also, so you've got to change with the market. You've got to be dynamic. You always got to learn. So those are my things. So 3 reasons. The first one is risk. Okay, very important. If you overexpose yourself, and I also say don't overexpose yourself to one stock. My rule of thumb is one holding should not take up more than 10% of your that's your EPF, which is entire portfolio value. All right. So just for round figures again, if you've got a 100 grand portfolio, I know it's a lot. I'm just saying this because percentage terms is easier. Not one stock should take up more than 10 grand initially. You shouldn't put in more than 10 grand, okay? And that shouldn't be put in one lump. See my previous videos. In fact, you click up on the eye there, you see it. My previous videos, you should scale in. So essentially, three so times 3,000. You should scale in really in 3 chunks, and that's what I always do. Because you're never going to guess the right price. You're never going to get the bottom at all. You always expect the share price to go down, but you've got to do a lot of quality filters to understand if the share price does go down. Why is it going down? Is it going down because there's a specific problem with the company? Or is it just because the market's going down? You've got to know that, okay? If it's going down because the company's got a problem and the story has changed, it's time not to scaling anymore. And so you limit your losses then, to about 3%, if that. If it goes wrong, then you lost 3%. If you've gone in full 10%, it goes wrong, you lost 10%, And that's one of the biggest problems of new investors. They want to go big on one stock, get rich quickly. You end up getting poor very quickly, okay? So be careful of that. Next thing is cash. Very important. Now, let me move my head here. If the company you're investing into, and if you're a new investor, I'd advise against this. If the company you're investing into is loss-making, okay, make sure they have enough cash to cover operations for at least 6 months, ideally 12. Now, just go to the cash flow statement on any sort of interim, which is 6 months, or any full year, and see how much cash they've used, okay, in the operations. Okay, so it's one of two things. Either a company is generating cash, okay, they're getting value, they're generating value from their operations, or they're not, or they're using cash. If they're using cash, they're making a loss. Their cash pile, whatever they have, is going down. So have a look how much they use in the last 6 months and the most recent, or the last 12 months, depending on what the most recent statement is, and see if they've got enough cash to cover the next 12 months based on that cash burn. It can change, it can go up as well as down, okay? So if you are looking at a loss-making company, and if you're a new investor, I'd advise against looking at any company making a loss. But look at the cash flow statement. How much cash they used, how much cash they got. That's all in the cash flow statement. At the bottom is how much cash they've got at the end of that period and how much they've also used. Now, if the company you're investing into is generating cash, it's creating value. And that's what's good for the share price, okay? Every now and again, you may get a company who's loss-making, like a miner or an exploration company that's going to become a producer or something. They're not generating value. They may release news now and again saying they released a pre-feasibility study which will show the value they're hoping to generate, and the share price may spike, but they're not generating value right now. They're using cash, okay? So they're not creating cash. They're basically investing the cash, but they're not generating any cash. So you may see a couple of companies, okay, oil and gas companies, all this, sort of developing their operations, developing something, but they're using cash. Okay, so those spikes are almost, you get, in the news when a company's using cash to sort of invest into a mine or invest in exploration. Those spikes you see on the news are basically insights into the future potential value generation, not what they're generating right now, because they're not generating any value right now. Okay, now, like I said, if you are investing in, and I'd advise any person who's new to investing, only look at companies that's generating cash. Because otherwise, if a company isn't generating cash, sooner or later, they will have to they'll raise some money somehow, Normally, they'll do it via a placing, which dilutes shareholders. And of course, it's not creating value at all. So, with a company generating cash, there's less chance they will have to raise money via placing, which raises shareholders. So, also generating value. That's what makes the share price goes up in the end. That's what all these companies that are pre-revenue, all oil and gas stocks, all resource stocks, all tech companies that are new to the market, people are only hoping they will get towards, value generation, which is cash generation from their operations. That's that's a nirvana. A lot of companies, a lot of oil and gas, a lot of resource companies will never get to that stage. I think it's a tiny percentage of resource companies actually get to the point where they become a producer, from exploration producer. It's a long way, it's a long time, it takes a lot of money, it takes a lot of fundraising, and then in the end, if they raise debt finance, they get debt, they have to pay that off over years if they get to become a producer. Why not wait? And just wait till they're generating cash, because there's always opportunity, share prices always dip, and then invest then. Then we'll have to come back to that market. That's what I did from September 2008 to September 2018 to now. I sort of, it took me about 6 months to get out of oil and gas and resource stocks, so I realised the market was getting harder. I was reading about macro news coming from China, of course, and any company sort of in resource is exposed to China's growth. China was getting worse, figures can come out. I decided to get out. I do think 2020 is going to be hard. I don't think it's going to be any easier. I mean, it'll be a bit easier. I think we'll see rallies, but I think the global economy is slowing down, which is not good for resource and oil and gas stocks. Okay, so that's why I'm now pivoting towards companies only. I've got a couple of stocks, still a sort of pre-revenue, they've got a bit of revenue, but they're loss-making. But I want to now start focusing on companies that are generating cash, making a profit. And that way, I think they're more resilient to a downturn if we have one. Okay, and the third reason, like I said, short video, third reason that can help you reduce your losses and increase your chances of making money. It's the share price. Okay, make sure the share price of the company you're investing into hasn't risen quickly or is not in a downtrend. Okay, because if this continues, I'll do another video on charts here. I want to keep this short. Essentially, if you see a share price below the 200-day moving average going down, the 200-day moving average is rolling over. You see an eye up there. You'll see other videos, but be careful because the share price is under pressure and it's in a downtrend. Best thing to do is wait for the share price to bottomed. You can, and it's plenty of time. Go with the trend. Trend is your friend. It's very strong. Don't try and pre-guess the bottom of a stock. I mean, I'm talking the lessons for myself. I always try and do that, and I end up the stock gets weaker and it goes lower. You don't do that. Go with the trend. And I don't know who it was who said something. Someone will quote on this, but you can have the bottom 20%. If you're trying to bottom fish, you can have the bottom 20%, the top 20% of a share price. Go for the middle 60%, where it's rising. Make sure it's in a trend, then jump in. Because then it's going in the right direction. The direction of travel is the right way. Okay, if you jump in when it's still going down, it may be on a spike, it's come down. And like I said, look at the RSI is a very good indicator, and it's worth looking at. I will go into that in the charts later on, but I just want to keep this short, and hopefully those three things. Remember, risk, don't overexpose. Okay, cash. The company has to have cash. Is it losing cash or is it generating cash? So two things you can do. If it's losing cash, it's going to go back to the market. It's going to be very bumpy. You may have big pops in the share price on news, but it will come back down because they need to raise funds sooner or later. If you want boom and bust, go with loss-making pre-revenue companies. If you want sustainable growth, go with companies generating cash, actually making cash, generating value. All right. And the third thing is never go for a company, the share price has gone up like that, the RSI has gone over 70, and everyone else is talking about it on Twitter. Ignore that. Share price, especially if the company not making any profit, it'll come back down. You haven't missed out. The fear of missing out. If there's one thing you have to do in the new year, is ignore the fear of missing out. If you can do that, you'll improve your chances of making more money, and you'll reduce your chances of making losses. All right. Or is it the other way around? That's it. If you found that in any way helpful, please give it a thumbs up. Please hit the subscribe button and the notification bell, and you'll get my next video straight to your inbox. Okay. And in the meantime, I do wish you a happy new year. Hope it's better. If you had a bad year this year, hope it gets a lot better next year. But like I said, try and focus on those companies that are less risky. They're not more, they're not a gamble. They're not a punt. They're more about investing rather than just punting. That's it. If you want to watch another video, by all means. Oh, by the way, subscribe. You can click on my face there, and there's a couple of other videos there. Happy New Year.